For as long as there have been markets, picking stocks has been part art, part science, and, let's be honest, a lot of the time a total gamble. But what if you could actually change the odds? Today, we're seeing an absolute explosion of data and AI that's transforming this age-old challenge. It's creating a whole new breed of investor. So let's get into it, how technology is remaking the market from the ground up.
It really all boils down to this one simple but incredibly deep question. Is a company's stock worth the price tag it has today? Or is there some deeper, truer value hiding just beneath the surface? Answering that? Well, that's the whole ballgame.
And this is where things get really interesting. You've got this constant tug of war. On one side, you have the company's actual health, its real measurable value. But on the other, you've got the market's mood, how investors feel about that company, which is all about psychology and emotion. And it's this tension that gives us the three main ways people try to pick stocks.
All right, first up, we've got the classic detective. This approach is called fundamental analysis, and it's all about playing investigator, digging into a company's health to figure out what it's really worth.
So the core idea here is that every single stock has a true intrinsic value, totally separate from whatever its price is doing on a random Tuesday. These analysts, they put on their detective hats. They're not getting distracted by the market's daily mood swings. They're digging through financial statements, economic data. Basically, they're looking for the cold, hard facts.
And to crack the case, these detectives have their classic tools, financial ratios. The PE ratio, for example, it's basically asking, hey, is the price I'm paying fair for the actual profits this company makes? The price-to-book ratio is more like, what if we just sold off everything the company owns? Is the stock price higher or lower than that? Each one of these is like a different piece of evidence, helping to build a complete picture.
But what happens when you give that detective a superpower? Because that is exactly what's happening right now with machine learning.
So meet the AI detective. We're talking about algorithms that can scan thousands of companies at the same time, seeing these incredibly complex patterns that a human analyst could never, ever spot. They're predicting which startups might fail. They're seeing the early warning signs of a financial crisis in economic data. They're even figuring out how sensitive the market is to certain news, and it's all happening in real time. But here's a thought. What if the company's health doesn't really matter at all? Well, that brings us to our second philosophy, the profit. This type of investor thinks the future is already written. You just have to know how to read it in the charts.
This is called technical analysis. And these folks, they pretty much ignore all the financial reports. Their argument is that all that information, all that news, it's already baked into the stock's price. So by studying charts of past prices and volume, you're not just looking at numbers, you're really analyzing human psychology on a massive scale to predict what the crowd's going to do next.
Two of the most basic ideas here are support and resistance. Think of a support level as a price floor, a point the stock just seems to have trouble falling below. And a resistance level is the opposite. It's like a ceiling the price struggles to break through. Technical analysts believe that when a stock finally breaks through one of these levels, it's a huge signal about where it might be going next. And they use all sorts of indicators, like one called the MACD. Now, it sounds complicated, but it's really just looking at the relationship between a short-term price average and a long-term one. When that faster-moving short-term line crosses above the slower one, it can signal that momentum is turning positive, a potential buy signal. And if it crosses below, well, that might be a sign it's time to sell.
Okay, so this brings us to our third, and maybe the most radical school of thought, the mind reader. The idea is, if the market is really all about human emotion, why not just try to measure that emotion directly? Why not tap right into the collective consciousness of the internet? You see, the fuel for this new kind of analysis isn't found in some dusty financial report. It's what people call the digital exhaust of our modern world. Every tweet, every Google search, every online news article. It's unstructured, it's messy, but it's also why they call data the new oil. It's raw, it needs to be refined, but it holds a ton of power.
And this is a perfect example of what I'm talking about. The dotted line you see here is the official government GDP data. But the solid blue line? That's a nowcast, a real-time estimate built from what we call alternative data, like shipping traffic and how many people are searching for certain things online. See how much more jumpy it is? But look closely. It spots those sharp downturns way faster than the official numbers, giving investors a huge head start. So what kind of data sources are we talking about here? I mean, it's everything. Millions of news articles from all over the world, social media feeds that act like a real-time mood ring for the public, what people are searching for on Google, even tracking the physical movement of goods through shipping traffic. So, how in the world do you turn all that noise into a clear signal? Well, the simple way is called lexicon-based.
You basically just count positive and negative words. But that method is, well, it's pretty easy to fool. The real game changer is machine learning. It doesn't just count words, it actually understands context, nuance, even sarcasm. It knows the difference between "this is a great company" and "yeah, great company." That's how you get a truly accurate read on what people are thinking.
So you've got the detective, the prophet, and the mind reader. You know, in the past, investors kind of had to pick a lane. You were one or the other. But in this new age of investing, you don't have to choose anymore.
And that brings us to the true revolution, the rise of the hybrid investor. The most sophisticated investors out there are now using AI to combine all three of these approaches. They're building these incredibly complex models that weigh a company's financial health, its chart patterns, and the real-time public sentiment all at once, using things like neural networks to find the perfect mix of strategies.
So you might be asking, why is all this happening right now? Well, the answer is in this one absolutely staggering number. It's estimated that 90% of all the data in the entire world was created in just the last 2 years. Think about that for a second. For the first time in history, we have enough raw material, enough data on company performance, on market history, on public opinion, to actually build and train these insanely powerful hybrid models. The data explosion lit the fuse for this whole revolution.
And all of this leaves us with one really big, fascinating question. In a world where these AI detectives, prophets, and mind readers just keep getting smarter and more accurate, what role is left for good old-fashioned human judgment and intuition in the markets of the future?